Welcome back to the channel. My name is Brad, and we have Kevin Kelly with us again to talk about his two new funds. And we're going to get an update on BITY and BAGY at the end and ask him how things are going. Welcome back.
Thanks for having me. Really appreciate it.
So you came out with two new funds on Ether, EHY and ETTY. What's the difference between the two?
Yeah, so the difference between the two is ETTY seeks to pay 3% a month out to shareholders and then get as much upside to Ethereum as possible. So it doesn't do 100% overwrite on the portfolio, which conversely, EHY does. So EHY owns exposure through ETPs to Ethereum, and then it does 100% overwrite on the portfolio to garner as much income as possible. And so what we're trying to do there is really just monetize the volatility to the maximum. That's why it's the max income strategy, while ETTY is a great way to think about, hey, I'm just going to monetize some of the volatility, bring in that 3% a month. And how we view it is it's a great way for people that want exposure to Ethereum, that want, as much upside to Ethereum as possible. It sort of like the people that own Ethereum and stake. This is a great way to get paid on it, and you'll have more exposure to Ethereum's underlying as opposed to EHY.
Let's talk about strategy. What I saw, and you can correct me if I'm wrong, please do. I saw that you wrote approximately about 11% out of the money on a weekly compared to a monthly strategy. Can you talk about how that strategy is working out?
Yeah, so we have very similar strategies with BITY and BAGY, where what we do is we write on weekly against the underlyings. And if you're a options derivative writer, what you want to do is you want what's called theta. You want time decay to happen as fast as possible. And so the reason why we choose weeklies is because the decay of that options time value happens rapidly with weekly options. So the way to think about it is typically, and we've seen this happen with Bitcoin, is the implied volatility is higher than realized volatility. And so that's true in, with stocks, and it's played out with Bitcoin, it plays out with Ethereum. So what we do is we want to capture that implied volatility, the monetization of that implied volatility as quickly as possible. And so one of the nice aspects of this is because we're doing weeklies, we don't necessarily also get stuck to certain price ranges. So if you write out on a monthly strategy, you're stuck at that index level or that price level, the strike, for a month. What we do is we reset consistently every single week. So if there's an upside, we can participate with the upside, and then we can the next week write on a higher level. So it's really the monetization of 4 to 5 times a month. You're capturing that implied volatility, that monetization of the volatility quicker. And then you're also you're trying to perform as much as possible lockstep with the price of the underlying.
That's correct. It really appears that volatility actually changes daily, if not weekly, and you're capturing the difference between having monthly and a weekly implied volatility capture.
That's right. And volatility we've seen can be very episodic. And what's important to note about volatility too is volatility can rise in up markets. So when Bitcoin had a recent rise, the volatility actually expanded and went up and went further out in the strikes. And so when we're looking at it on a weekly basis, one of the nice aspects that we can do is when volatility rises, we can write further out if we want to. We can write further in. So we have the ability to write. Typically, we're within that 5 to 10% range. So if volatility comes down, we'll be a little bit closer to the spot underlying price. But when volatility rises, we can go further out to still generate that income and have as much more upside embedded into it. So what's important to note is volatility can go up and up markets, and it certainly can go up and down markets, and so we go further out. So that's a nice aspect and flexibility within that weekly aspect. And so we've seen even volatility on the Ethereum side go out, up into the 70s, 80s, 90s. We're around a 95 vol right now with Ethereum. So it's nice because for ETTY, with that rising volatility, we don't have to write on as much of the portfolio to generate that 3%. So we can capture the upside, focus on delivering those 3% while giving that upside. And then on EHY, if you step back and think about it, at a 95 vol and we're writing on 100%, you're getting a voracious amount of options income to you. And so that really kind of helps buffer portfolios, depending on where volatility is, and volatility is fast moving. So a lot of investors seek comfort in getting that high implied volatility premiums to them.
Is there any targets for EHY on distribution rates?
Yeah. So we have not made a distribution yet on the products, but what we state in the prospectus is we're looking to target around a 50 to 80% annualized income rate. And so we're actually kind of in the upper area now as volatility is moving up. We're kind of looking at the 60, 70 percent range on an overwrite while still being 10% out of the money. So what's nice is with EHY, even though we're writing on 100% of it on a weekly basis, we're trying to get 10% or more upside to the spot underlying. So that really helps as well because we can participate to the upside. So we're not just distributing out capital and it's not being destructive. We're trying to be as constructive as possible, get as much upside, generate as much premium in that 50 to 80% range annualized.
So Kevin, what are the actual fees on these funds?
So these fees are 75 basis points is a total expense ratio for both EHY and ETTY. And we think they're competitively priced option strategies where you get that professional options management where we're doing the heavy lifting on a weekly basis. Those are the fees on an annualized basis.
How does this actually fit into a portfolio compared to something like Bitcoin?
The way to think about Ethereum is it's a long-term hold, right? Because it still is a nascent technology where you don't really have AI without Ethereum because all the new builds with stable coins, AI agents, things like that is going to be happening using Ethereum network. And so we're still in the infancy of what Ethereum can do and the build out of products on the Ethereum technology network. And so one of the aspects we think and why you want to use it in options income strategy is you're going to own it for the long term. And we're trying to give you as much upside in the strategies as possible. And so this is really a hold for the build out of technology. We think it's very comparable to like the 1980s when Microsoft was coming about and really we started building technology and internet. And so we think it's akin to that. And you'll hear terms like Web 3.0 and things like that. And it's very similar. And so there's a lot of big financial institutions and corporations that are building out their technology for the Ethereum network and products. And so it's going to be a long-term play. So we think having an option strategy where you can generate that income, whether you want to reinvest it back into the ETFs or you just want to take that income, it serves a role in portfolios. And that's differentiated than Bitcoin, where Bitcoin is really a digital capital, where Ethereum is digital infrastructure. And so they have two completely different roles in the digital asset ecosystem. And as we've seen with Bitcoin, it's got a very big network. It's matured over the years. It's used as digital capital. So it's very different. And that's why you're seeing Ethereum have higher implied volatility than Bitcoin, because it is dependent on people investing in making applications and doing development on the Ethereum network, where conversely, Bitcoin is more as a digital store of capital to be used in the digital native ecosystem.
let's talk about when will we see that first distribution on this fund?
So these funds are constructed the same way on a distribution basis as BITY and BAGY, and that is at the end of the month. So we do monthly distributions. So the first distribution will, at record date, will be the 26th and payable on November 28th. And so if you look at these funds, one of the things you can see is there's calendars available on the website where you can see at the end of the month we pay the distributions, and we think monthly distributions on a portfolio management basis, especially for long-term investments like this, like these, we believe these types of strategies, whether it's the Bitcoin options income or the Ethereum options income, are really long-term holds. And so when people are thinking about managing their portfolios, we think, these are long-term, technology plays, 3-year, 5-year, 10-year holds. And so people can take that distribution and they can reinvest it to buy more shares. So the power of compounding. So, we think what you could do is, double your shares in few years, 3.5 years, depending on the distribution rates. And we pay out on a monthly basis. So that's on a portfolio management basis. We think that is the optimal scenario for long-term investment strategies.
I have to ask, why not weekly versus the monthly on distributions?
Yeah, so that's a great question because you're seeing a big trend right now where people want to get weekly pays, and part of it is portfolio management. And as we're managing the cash, especially around the option strategies, around distributions, shareholder of records on times, creation, redemption units, and so we want to make sure that distributions are being made for the actual income generated. And so when you're managing strategies and due to creation redemption, it is more efficient and better for shareholders from a portfolio management basis on my side to do a monthly distribution.
Let's do a follow-up on BITY and BAGY. How have those funds actually been performing, and is there any lessons learned?
Yeah, I think what's nice is when you look at BITY and BAGY and the strategies that are underlying them, they've executed it per what we're supposed to be doing for the strategy that we've outlined. And so we've seen Bitcoin actually trend sort of sideways, and due to the fact that we're monetizing the volatility, there's been periods since we've been out where we've actually outperformed Bitcoin. I don't have the latest numbers, but what you can see is during sideways to flat markets, these strategies should be outperforming because you're generating income. And in down markets, they're really meant to outperform because you're generating a high amount of income. And so what's been great about the strategies is that we've really took what we've said we were going to do and we've executed on it. And so we're really enthused by the growth of the AUM. We're enthused by the volatility we've been getting. We've been enthused by the distributions we've been making on the targets. So as BITY and BAGY have played out, that's why we thought it'd be great to add these complements with ETTY and EHY, given where volatility is in the digital asset ecosystem.
Anything else you want to share about Bitcoin and your maybe a price prediction on Bitcoin?
Yeah, it's hard to predict Bitcoin prices because Bitcoin has become really institutionalized over the last 18 months. And so what we've seen is historical and seasonal trends actually have not played out in the underlying. But what's been nice is Bitcoin as a digital asset and as a store of value has done well. And so we've seen that one of the reasons why it's done well historically, global M2 as well as other underlying factors, inflationary environments, it doesn't track one for one, but what's nice is the underlying thesis for owning Bitcoin is still in place. And we've seen global M2 go up. So if we can keep that historical trend, I think there's going to be some good upside in Bitcoin over the next 3, 6, 12, even 2-3 years as the technology gets better, as institutional adoption happens. So we're actually really excited by where we think Bitcoin can go in the short term and the long term.
So that's a no on giving us a price prediction.
I can give you a prediction on Bitcoin. The volatility will remain elevated, and we expect to continue to produce the amount of income and distributions we have.
Can you give us the same prediction on Ether?
Yeah, so on Ether, what we've seen is even with the big run up, volatility has remained there, and you're seeing a massive amount of institutional adoption from TradFi, and so I think there's really a underlying put. Where bottom level for Ethereum now, due to the voracious demand for stablecoins, which is predominantly outside the U.S. market. Now, I think Ethereum will remain really volatile due to the fact that there is competition out there from other coins, Solana being one of them, as well as other consortium of big institutional players utilizing other coins for their own rails for AI and stablecoins. So due to the increased competition, I think Ethereum will remain really elevated over the next 5-10 years, because blockchain technology, whether it's public or private, is being invested in, and the big mature blockchain network that has done well has been Ethereum, and I think it continues to do well, but there is going to be competition, and it's going to be fierce.
Any closing remarks, Kevin? Really greatly appreciate you.
Yeah, so the only closing remarks I have is that we believe that digital assets serve as a great portfolio diversifier, and people should have exposure in some form or facet to digital assets. We think using a strategy monetizing income is a great way to do that, to ride out the volatility, because as I said, these are still nascent technologies and there's still a lot of build and competition for them. But for investors, having a 2%, a 5% position, depending on their risk metrics and their tolerances, it could be really beneficial for portfolios. Now, it is volatile, so you will need to ride those out. But we think everybody should have some exposure to the digital asset ecosystem.
Thank you, Kevin, and I look forward to having you on the channel again.
Thanks for having me.
So that's a no on giving us a price prediction.
Yeah, well, by the time this interview comes out, I'm sure I'll be proved wrong. So that's why I always try to steer away. I'm like, it's going here, and then it comes out, it's already gone the opposite way. So I try to steer clear of that.
Somebody asked me that the other day, and I said 175 and 80. And the guy's looking at me like, "What?" I'm like, "It's going to be in that range."
Yeah, it's a great range.
I said, I think the new floor is 80. I think the new high is going to be 175, and we're going to be in that range for who knows how long.